การนำเสนอข้อมูลของบริษัท PSL สำหรับไตรมาส 4 แล้วก็สำหรับปี 2017 นะคะซึ่งคุณคาริด ฮาชิมกรรมการผู้จัดการบริษัทก็จะนำเสนอข้อมูลในเรื่องของอัปเดตของข้อมูลตลาดการเดินเรือแล้วก็คุณกูชูฮาชิมกรรมการทางด้านการเงินก็จะนำเสนอข้อมูลอัปเดตของตัวเลขข้อมูลคลังเงินของไตรมาส 4 แล้วก็สำหรับปี 2017 ส่วนสุดท้ายก็จะเป็นคำถามคำตอบนะคะขอเชิญคุณคาริดค่ะ
Sawadee krab. As usual, we will make the presentation in two parts. In the first part, we will talk about the industry structure, and in the second part, we will discuss the finances of the company. So as you know, pressure shipping is part of the dry cargo market, and if you look at us in terms of the type of ships that we own all the types of ships beginning in the handy size and ending up in the ultramax space. This is a long chart of the BDI and shows you that during 2008, the market peaked at 11,793 points. And thereafter that, it has been on a downturn for quite a while now. And we have finally passed the bottom in the first quarter of 2016. If you look at the BDI in terms of annual averages, it shows the trend a little bit better. The last all-time low was in 1986, and then we had the ultimate all-time low in 2016. And now, as you can see quite clearly, 2017 has shown quite a significant improvement over 2016. And as you can see from the first month of 2018, it's already appearing better than 2017. If you look at the actual BDI graph between the 1st of Jan 2016 and the end of December 2017, you can see that we've had 4 low points, but each of the low points has been higher than the previous low point. And if you look at the peaks, there are 3 to 4 peaks here, and each of the peaks has been higher than the previous peak. So it looks like it's on a ascending trend. If you compare the average quarterly BDI, which is the pink bars, versus the amount of ships scrapped, which are the green bars, then you can see that there is an inverse relationship. That is, when the BDI is weak, as it was in the first quarter of 2016, scrapping is strongest at that point. And as the BDI starts to go up, as you can see in quarter 2 of 2016, it was almost double of quarter 1. And you can see that scrapping started to come down. And as quarter 3 improved, scrapping dropped further. So if you look at the average for the year, the average BDI was 673 points in 2016, and we had almost 30 million tons of ships being scrapped. Similarly, if you look at the average of the BDI for 2017, you can see it was almost double that of 2016 at 1145 points. And unfortunately, scrapping came down to less than half of what it was the previous year. China has been importing a lot of coal, and there are many reasons why it has been importing a lot of coal. Firstly is, of course, that they're trying to shut down many of the smaller, inefficient mines where a lot of poor quality coal comes out, and they don't want to have pollution. Also in the smaller mines, there are a lot of unsafe practices, and many people die there. And this leads to protest, and the Chinese government hates any form of protest. So again, they want to shut down these smaller mines. China has put down a plan to close down 800 million metric tons of mining capacity on an annual basis, all the way up to 2020. But if you look at what they've already achieved almost 2/3 of that target has already been done by the end of 2017. 500 million metric tons had already been shut down. This year, China aims to shut down another 150 million metric tons of mining capacity. The government also has been cancelling quite a few power plants, coal-based power plants. Having said that, they're also still opening many coal-based power plants because the total energy requirement in China is quite staggering and quite massive. But they're trying to reduce their dependency on coal. Now, because of the closure of local mines, imports have continued to rise. And if you look at 2017, we reached almost 271 million tons, or a 6% increase over 2016. Now, the big question is, can these imports into China, are they sustainable or not? So if we look at what's driving the imports in China, then you can see that, first of all, China is shifting from making normal steel or product steel into making specialized steels. To make specialized steels, you need much higher quality iron ore and you need much higher quality coking coal. Both these come mainly from imports. China, of course, has also slapped a ban on North Korean coal. And the last year, full year, when China imported from North Korea, it was almost 23 million tons. And this travels a very short distance by sea and sometimes only by land. So therefore, when it is now being transported from Russia or from China or from Australia or from Indonesia, the ton-mile impact of this 23 million tons has increased significantly. Now, if China is very serious about reducing pollution, and one of the ways of reducing pollution would be to have better quality iron ore, better quality coking coal, better quality coal being burnt in their steel mills and power stations, and that would reduce the volume of pollution. So this would mean more imports. China has already withdrawn more than 1,000 licenses for iron ore mining, and this was just done in the year 2017. So you can see that China is taking a lot of steps to enforce their non-pollution or their reduction in pollution mandate that they have put out for themselves. A new rule has now been put into force that and this was done only in the end of October last year, saying that from the 15th of November of every year till the 15th of March of the following year, steel mills and cement factories must cut down production by 50%, and aluminium firms must cut down, aluminium producers must cut down their production by 30%. The idea being that in the winter months, pollution is very strong, and if they reduce production on these three key industries, then pollution levels will drop. Now, this was done for 4 provinces and 31 cities in the first year, that is last year and up to March, middle March this year. But they have now said a new further ruling has been made that it's not going to be in just 4 provinces in the future, it's going to be in 14 provinces, which means basically 70% of all steel making capacity will come under this new ruling. That is, from mid-November to mid-March, they have to reduce their production by 50%. Because this is now known well in advance, we think that in the 8 months that is there, where there is no restriction, the steel mills will produce as much as they can, build up inventory so that they can sell from inventory in the 4 months when they are forced to reduce production. In terms of steel making capacity, China is trying very hard to remove the inefficient steel making mills that they have. And they've already cut out quite a lot of that capacity. And again, they want to reduce this by almost 800 million tons by the end of 2018. If you look at the latest available data, iron ore imports last year in 2017 were up by 5%, or about 50 million tons, to 1,075 million tons. Coal imports were up by 6.1%, or 15.5 million tons additional, at 271.2 million tons. Steel production this year is up by 4.8%, or for 2018 is up by 4.8%, 38.4 million tons additional capacity, additional steel produced at 845.1 million tons for the year. Exports are down by almost 31% or 33 million tons to 76 million tons. Inventory is down by 24% to, or 2.5 million tons to 7.9 million tons. So if you take the excess production, the reduction in inventory and the reduction in exports, you will realize that China has consumed almost 10% additional steel during 2017, or almost 68.3 million tons of additional steel, reaching a total of almost 783 million tons for last year. Now, we think that this type of capacity or deployment or capacity of steel in their economy should continue in 18 and 19. This is the same information that I've just given you, but in a graphical form to show you what is the percentage change and what is the monthly change between 2016 and 2017. And this is for iron ore imports, which is the left-hand side of the graph, and for coal imports, which is on the right-hand side of the graph. If you look at soybean imports, China has broken almost every record in this trade, and last year imported almost 100 million tons, 96 million tons of soybeans, which was almost 15% higher than the year before. If you look at steel production, which is the top right-hand graph, you can see that how steel production has been changing based on the month-on-month changes as between 16 and 17. If you look at the steel inventory, which is the left-hand side lower graph, you can again see on a month-by-month basis how inventory has been changing between 2016 and 17. And similarly, if you look at exports, you can clearly see that in 2017, China made a big effort to export less because they were consuming much more in-house. Coming to the supply side. If you look at the supply side and look at the changes made during 2017, you can see that we added almost 23 million tons of ships during the year, which is approximately 2.93% as compared to the volume of tonnage that was available at the beginning of the year. The other thing to notice is that the world tonnage in the dry bulk space has now reached 814 million tons, with an average size of 73,000 tons per ship and an average age of 9 years. If you look at the forward position, you can see clearly that approximately 9.25% of additional ships have still to come all the way up to 2021. And what we have done here in this chart is to give you this breakdown on a basis of each year in the forward position, as well as by type of ships and size of ships. If you look at the order book, that is the amount of ships ordered in any one single year, you can see that in 2016 and 17, there was very little ordering that took place, and of the ordering that took place, you can see more or less all of it was concentrated in the Capesize or the very large ore carrier sector. And that is the reason for that is that there's a big replacement program going on for those types of ships, because many of them have reached their end of their use by date and now they are being replaced. If you look at January 2018, once again, you can see a lot of ships have been ordered, but more or less all of it is in the Capesize and the very large ore carrier sector. In terms of scrapping, you can see that we are not doing too well. We should be scrapping more ships, but unfortunately, it looks like scrapping has taken a backseat because markets have become stronger, and the expectation is that the strength in the market will continue in the future. Therefore, less desire to scrap ships. And you can see that in the month of January, a very small amount of ships have been scrapped. Slippage. This is the difference between what is projected to be delivered at the beginning of any one year and what is actually physically delivered by the end of that year. And if you look at slippage, it also has an inverse relationship with the market, with the BDI. That is, when the BDI is strong, slippage is low, and when the BDI is weak, slippage is high. So for example, if you look at 2016, when BDI was quite low, slippage was almost 50%. And if you look at 2017, when the market became slightly reasonable, slippage dropped to 34%. Again, this is a chart which shows you the January effect. That is, in terms on the left-hand side, you can see the ships delivered month by month, and you can see clearly that in the month of January, whether it is 2016, 17, or 18, that is the maximum number of ships that will be delivered in that year, in that 1 month, as compared to any other month in that year. And you can see clearly that in 2017, the volume of ships delivered has dropped, and similarly, you will see a similar drop in 2018 and 19 and 20. In terms of scrapping, the right-hand side of the graph gives you the same thing in terms of scrapping, what was scrapped on a month-by-month basis. And you can see clearly that 2016 Q1, which was a very weak quarter in terms of the BDI, scrapping per month was very strong. But once the BDI started to improve, you can see how scrapping started to come down. And in 2017, how it has been less, almost half of what was there in 2016. And if you look at 2018, it looks like it's even lower than what we had in 2017. If we were to look at the forward position, then we would see that for 2018 and 19, roughly net supply growth will be about 1% per annum. And this is based on two factors. One is slippage at about 35%, and the other one is basis scrapping at 15 million deadweight tons per annum. And this is basis what we saw happened in 2017. So we assumed similar type of results for 18 and 19. If we use those two assumptions, then you will get roughly 1% net growth per annum in 18 and 19. There are some regulatory changes that are coming in. On the left-hand side slide, I've shown you a picture of what is known as the ballast water management system. This is from one of our ships. It is a very large piece of equipment, and you can see clearly how big it is. In the older ships, the engine room is not so spacious, and for you to put this type of big equipment in the engine room would be almost impossible. So a ship built, which is say 15 years old or 20 years old, will find it very difficult to retrofit this. But this becomes law as of the fourth quarter of 2019 onwards. So next year, last quarter onwards, this will become mandatory. And it's already mandatory in places like America, where our ships are trading. Therefore, we have the systems already on board. And if you don't have those systems on board, you can't trade in America even today. On the right-hand side, we've shown you what is the next regulatory retrofit that will be required of the world fleet. Ships currently burn very dirty oil, or oil which contains sulfur in excess of 3.5 or about 3.5% sulfur. Now, when you burn such oil, you create two things. You create a lot of particulate matter, and you also create a lot of sulfuric rain or sulfur or acid rain in the ports where the ships go and dock. So people who live on the coastline have all protested, saying that we need to cut down this particulate matter as well as cut down the acid rain that we get from these ship exhausts. And the way to do that is either to burn clean oil with a sulfur content of less than 0.5%, or burn the dirty oil but then put a scrubber on board to clean the gas that comes out, which will have an exhaust gas showing a maximum sulfur content of less than 0.5% and no or very low particulate matter. But the cost of the ballast water management system is about $1 million, and the cost for the scrubber system is about $6 million. So it becomes very, very expensive, especially to retrofit on older ships. Now, the scrubber or the Clean Air Act will come into force on the 1st of January 2020. So again, Q4 will be the ballast water management system, and from the 1st of January 2020, the new regulation for scrubbers will take place. Now, when you fit a scrubber, there are lots of things which are still not yet known. And amongst the unknowns are that what will be the differential in price between dirty oil and clean oil. Obviously, the greater the difference in clean oil price and dirty oil post January 2020, the better it becomes to fit a scrubber. The less the differential, the less incentive to fit a scrubber. Now, if you look at the normal ship burning about 25 tons of oil and you take a price differential of $400 and you say that this ship will be at sea for about 200 days, then you can say that even though the scrubber costs you $6 million, you could have a payback period of about 3.5 years. So it's a pretty quick payback period. But keep in mind, this is based on a $400 differential between clean oil and dirty oil. If this differential narrows, then the payback period will become longer, and therefore is less incentive to install a scrubber unit. The question then, of course, is that as a ship owner, we will install all of this, and the client who wants our ship must pay for it in some way. And you know how it is with any client, nobody wants to pay anything, nothing extra. So difficult to pass on the cost. And so most ship owners will look at the clean oil option, just burn clean oil. Anyways, it's the problem for the client. He has to pay for that oil, and let him pay it. And if he wants us to put a scrubber, we can consider it, provided he gives us a long enough contract with a good enough price that we can recover this cost on a steady income basis. The other problem with scrubbers is that they are only so far lab tested. Very few ships have got them on sea, and though it works very well on land, we don't know whether it will work as well at sea, because remember, a ship has two motions. It also goes up and down like this. This is known as a pounding motion, and it also has a rolling motion. And the engine vibrates. So the scrubber, which is attached to the engine, will face three things. It will face the movement of the ship going up and down, it will face the movement of the ship rocking from side to side, and it will also face the vibrations from the engines. And we don't know whether the scrubber, which is based on land and works perfectly, will also work perfectly at sea. So this is something that we have to also go and check. Then they are also lab tested. We don't know whether the tests will work in real life and whether these lab tests have been manipulated or not. So it's an expensive option, and most people in shipping, at least all ship owners, don't have that much of cash available, because let's say in our case we have got 36 ships and we want to fix a scrubber on each of them. It means we would be spending 36 multiplied by 6 as a capital expense. That is, you're talking about almost more than $200 million being spent by us on fitting this, retrofitting it. So for ship owners in general, it's going to be very difficult for them to simply go ahead and fit a scrubber, because the capital cost is so high. So at Pressure Shipping, what is our plan? Our plan is for the first year, to burn clean oil. Our ships are all capable of that. They're young. They have no problems with this. During the time, we hope that the scrubber cost will come down. And if it comes down and we see the differential in oil price going up, then we can seriously look at retrofitting the scrubbers. So at least for the first year, our plan is just to burn clean oil and observe what's going on, and then make an informed decision. This chart shows you how many ships will become 15 years or older, provided no scrapping takes place in 18 and 19. As of the 1st of January 2020, how many ships will be greater than 15 years of age? Now these ships, if they survive, that is, there's no scrapping that takes place in 18 and 19, then these ships will have to face these two big costs. So this is quite important. You must understand, there's a lot of ships that are there like this. Now, if we were to analyze this further and look at the ships that would reach their third special survey cycle, or 15 years of age, or fourth cycle, 20 years of age, or fifth cycle, 25 years of age, or sixth cycle, 30 years of age. Now, the ballast water management system becomes mandatory once you cross one of these special surveys. So if you look at fourth quarter 2019, you can see that 11 million deadweight tons of ships will become 15 years or older, 15 years or 20 years or 25 years or 30 years. The exact birthday. They will cross these milestone birthdays during that quarter, which means 11 million deadweight tons of ships in Q4 will be forced to spend on ballast water management systems. Whether they have the money or not, whether the ships are so old that it makes no sense, then scrapping will go up to that extent. When you come to 2020, this becomes even more intensified. You now have got both the ballast water management system as well as a scrubber to install or burn clean oil. Now, the older the engine, the less chance for it to burn clean oil. It's like saying, if I were to give you an example in reverse, that if you have a Lamborghini car and tomorrow the Prayut government under Section 44 says all cars have to burn only diesel oil, what do you think will happen to all those fancy Lamborghini cars? They will all break down because they cannot burn diesel oil. They need a very high quality of oil. Our case is the reverse. Our engines are designed to burn dirty oil. The law now says you have to burn clean oil or put a scrubber. Scrubber costs $6 million. My ship is 18 years old or 20 years old. Am I going to spend $6 million on putting a scrubber, or will I try to burn clean oil? Anyways, I can't burn clean oil because the ship is very old. The engine cannot take it. And I can't spend $6 million on a very old ship. So chances of scrapping going up in the year starting from Q4 19 is quite strong. And this is what I wanted to show you in terms of actual ships that cross their 15th birthday, their 20th birthday, 25th birthday, 30th birthday. Because at the time when you cross that birthday, you have to do all these things. So most owners, what will they do? If they burn clean oil, they will slow down the ships. If they slow down the ships, you will remove supply from the market. Approximately 17%. I've shown you the calculations in this slide. And what have we been doing? As a company, what did we do? First of all, we raised equity in the middle of 2015. In 2016, when the market was absolutely dying, we raised 2 unsecured bonds, one of $100 million at the beginning of the year, the other at $55 million at the end of the year, both covenant light and bullet repayments. And the cost is less than 6% per annum for us. Then we also sold 17 ships during this period of time, of which 15 of those ships were sent for recycling. And we took delivery of 1 Ultramax ship, which was still on order, and we have no further capital expenses coming up in the future. Just looking at China once again, because China is becoming more and more important for the dry bulk market, you can see that though the GDP growth rates in China have been fluctuating quite a bit, but if you look at the iron ore imports, if you look at the coal imports, if you look at the steel production, they are not really linked in very close fashion to the GDP numbers. They've all been growing whilst the GDP has been going up and down. So what is our strategy? Our strategy is for the next 2 years is to fix our ships on longer term charters, because we feel the market will go up strongly enough and allow us an opportunity to employ this tactic of fixing ships on longer term charters. This is a snapshot view of the company's assets. Right now, as of the end of last year, we have 36 ships with us. Average age is only 6.25 years. The average value, insured value, is about 673 million. The book value is about 717 million. The deadweight is about 1.6 million, and the average size per ship is about 44,000. This is our forward book. These are what we've already pre-booked and at what price. You can see from this that we have approximately 17% of our existing fleet covered on long-term charters, and that leaves 83% on the spot market. And the spot market is starting to move up very nicely. So it means that we have a very large position available to take advantage of any higher movement into the spot markets. If you look at market segmentation and look at us and compare us with the standard or the benchmark by the BDI, if you look at the BDI benchmarks, you can see that in the handy-size sector in Q4, we outperformed the market by about 12%. In the Supramax sector, we underperformed by about 10%. and in the Ultramax space, we outperformed by about 16%. If you look at the whole year of 2017 as an average, we outperformed on the Handysize by about 28%. We underperformed the Supramax index by about 10%, and we outperformed on the Ultramax by about 10%. So overall, you would say that we could get a very good mark. We've done much better than the market. Coming to the financials, Khushru will take you through that.
Yeah, sure. Position with shipyard, as you know, Sanfu, we have reached the settlements, and the unsecured loans, which we had $32 million, have been repaid in the last quarter of last year. So that finishes the matter of Sanfu. All ships which are supposed to be built by them have been built, delivered. Whatever left were cancelled, and so that finishes entirely our new building program with Sanfu. With Sainty again, all ships, whatever 2 ships which were supposed to have been delivered, were delivered, and thereafter we did not take delivery of any other ships. And as you know, out of the 12 contracts which we had for new building orders, 3 we received the refunds, and the rest of the 9 are in the arbitration process. Under the arbitration process, the 9 ships have an advance of approximately $65 million, which is pending, and this is what we are arbitrating for. If you look at the financial highlights of the income statement or the P&L, 2017 has been a rather good year. And each quarter has shown an improvement right from, in fact, right from the first quarter of 2016. So right from 2016, if you look at it quarterly, it has been an improvement. So the 2016 first quarter has been the low point in the recent past, or perhaps in fact the lowest point in history by far. So if you look at the numbers, revenues were up in spite of the fact that we operated 36 vessels instead of 40. So revenues were up because the pricing was better, that is the TC rate was better than the previous year. Our annual time charter rate was approximately $9,500 as against $6,500. And if you look at the fourth quarter, that was even more. We were at $10,728. So if at this particular time charter rate, that is 9,500 on a 350-day basis, you see, if you look at the operating profit or recurring after taking out all extraordinary gains and losses, we were at more or less zero profit or zero loss in 2017 in terms of the actual operations. So which means that on a 350-day basis, 9,486 or 9,500 with an operating expense of about 4,400 is some sort of a break-even level. And as we do better, like we did in fourth quarter, we had a time charter rate of 10,728 with, in fact, a slightly higher operating expense than 4,400. We start making profits, and we made a profit of about $4 million on a recurring basis. That is the operational profits. So this is where we stand. Operating expenses, of course, have been under control. They have been probably at a all-time low last year. Now that our fleet will start getting older year by year, we might have slight increases, but then that will, of course, that will not be overly significant because our operating expenses remain under control and much, much better than what they are of the others in the industry when we benchmark ourselves with others in the industry. In terms of the balance sheet, if you see, our cash balances have gone down. This is on account of the $30+ million which we had to pay to Sanfu to repay the loans. So even after that, cash balance is still very, very healthy, approximate $60 million. And hopefully, as the markets get better and as we do better in terms of our earnings, we will be increasing our cash balance and using it to bring down our debt. So this is what we should be looking for in the next 1-2 years, is to have whatever positive extra cash flows are there, use that to bring down the debt levels. And at some stage, bring it to very reasonable levels, whereby we can perhaps start the dividend payment program. So therefore, as advances to Senti, as I said, is approximately $65 million. No more advances to Sanfu pending. Value of ships is approximately $700 million. Total assets, 800. Our debt, if you look at debentures as $155 million, $168 million is after valuing the swap on the asset side or the liability side. So if you look at it as a real position of $155 million of debentures, we have unsecured debt of $155 million and $350 million of secured debt. So all in all, total $470 million. This is something which we would like to bring it down. However, even then, even with this sort of higher debt equity is now lower than what it was at the end of the previous year, that is 2016. So once again, this has also started in terms of now bringing down the debt levels. In spite of having one more ship delivered, one more loan coming into the books, the debt level has actually come down. And this we hope and expect that in the next 2-3 years, we will see the debt levels and the debt to equity ratios dropping down further by perhaps about 50%. As I said, crewing costs we have are under control. 2017 saw a reduction as compared to 2016. This is, of course, as you can see, mainly on account of, slightly on account of crewing costs, and the bigger saving is on account of the dry docking and special survey, because of the fact that we have newer ships. But now as these ships start getting older, our average fleet age, which is 6.3 now, as it starts getting older, we will have now the dry docking special survey expenses coming in. But if we compare these operating expenses with the benchmark or with the industry, as you can see, we are consistently, over the last many years, anywhere around $1,000 to $1,400 less than that of the industry. So this is a very, very big advantage with which we operate. So 2016 was about $5,000 for the industry. As against that, pressure shipping had $4,086. So, and this particular advantage or gap of a favorable gap or a favorable variance of approximately at least $1,000, we hope to maintain as we go along in the future. The next slide is the same information, but it gives you an idea in terms of a pictorial form. Now this slide gives you an idea of how we have come right through 95 in terms of the 3 or 4 major parameters or the major factors which we have to take into account. Number one, the top line of this particular graph is the size of the fleet. So as you can see, in 95, so approximately 22 years back, our average size of our fleet was less than 20,000 deadweight tons. We are now at 44,000 1,000 deadweight tons. So we have more than doubled our average size. This is on account of the fact that when we started off, we were in the small handy size sector only. Now we are in the bigger, and in fact the biggest geared ships is what we own now in the form of the Ultramax ships which we have. So that is on the size. So in terms of size, we have gone much bigger. In terms of age, which is the top boxes which you see, we had an old fleet sometime in 2006, 2007. This is near about the last boom cycle which we saw. We had a fleet with about 20 years of average age. We have brought that down now through our fleet rejuvenation program to about 6 years. So we are the youngest in history of our own history. In terms of rates, we saw the bottom in 15 and 16 at around $6,300, $6,400. We have now started to go up, and in fact in 17 we went up substantially from 6,500 to 9,500. That is more than a 40% increase in a year. Hopefully this will go on, and because of the fact that this 9,500 it was achieved, the gap between that line of time charter rate and the operating expenses, the last line, the last graphic, has increased substantially because the operating expenses have not increased, or in fact have actually come down. So now we have a very decent gap between the two of over $5,000 per day per ship. That $5,000 goes towards depreciation. If you look at it from a not cash perspective, interest and administration expenses. And that's how we have a break even. So therefore, since we had broken even in this particular year in 17, you could say that the difference between the 9,500 and 4,300 of operating expenses was actually the total interest, depreciation and the admin expenses. Debt to debt, funded debt and debt to equity ratio, as I said, this is the year where we came down. We reached the peak, that is a previous peak in terms of debt level at about $480 million, including the unsecured debt, that is the debentures, in 2016. Now 17, we brought that down to less than $470 million. As a result of that, in spite of the fact that equity reduced slightly because of the loss which we had, in spite of that, the debt to equity ratio has now started dropping, and it has dropped from 1.28 levels to about 1.24, 1.25 levels. Similarly, funded debt to EBITDA, that is the debt if you compare it with the cash flows, once again reached the peak in 2016 at 20.2 level times, which is of course very, very high. This is on account of the low EBITDA. Now that has come down to 8.5. As we see cash flows improving, as we see time charter rates improving, this should also come down to around the 6 times level, which is what the financial covenants are with our secured lenders. We probably will request waivers from our secured levels also for this year, but this time it should not be very difficult to get anyway, because we are at a point where all lenders, everybody understands that this will perhaps be the last year in the recent particular years or the recent period where we will be asking for these waivers. In terms of cash operating profit, once again, although we had a loss in this year, 2017, cash-wise, it was a very healthy profit. So this is again showing you the curve, the top curve. We saw a negative position in 15 and 16, turned the corner, turned perhaps quite dramatically, and from -5 on the cash side in 16, we are now up to +28. So very, very good. Very close to break even on a non-cash side. That is, if you consider the depreciation also, 17 is very, very close to 0. So this is the inflection point as we see all around. Similarly, if you include extraordinary gains, losses, once again, similar picture, near break even in terms of after including everything, depreciation, etc. But if you strip out the non-cash charges, mainly depreciation, then a very healthy positive cash profit of $27 million. So a big inflection or a big change as compared to the recent past. Dividend policy remains the same, as we touched upon that. Last 3 years, there hasn't been any dividend. Hopefully, as we go along, as things start moving upwards, we should be getting back into a dividend payment mode in the near future. Now, if you look at the financial profile as compared to of 2017 as compared to the last 5 years before 2017, these numbers also show a similar picture or tell you the similar story as we have been saying, that 17 was a year of turning the corner. So in all particular parameters, as you will see, everything looks better than what it has been in the recent past. One dramatic number which perhaps you can see is that in spite of having just 36 ships, our EBITDA, that is the cash flow, in 2017 was $53 million. This is near about the highest in the recent past. The last high was in 2013, but that was with about 40 ships. So in spite of having 10% lesser ships, we still have a very, very healthy EBITDA. Once again, as I said, this should improve as we go along. Debt to EBITDA started coming down to reasonable levels from a peak of 20 times last year, come down dramatically. Daily earnings, now we have very, very close to the 5-digit mark of 10,000. This has not been seen in the last 10, 12 years. Hopefully, as things get better, we perhaps will see a 5-digit time charter rate also. We are very, very close to that, of course, 9,500. If you compare that with what it was in 15 and 16, that's 6,300. This is up by almost 50%. Operating expenses remain under control. Profitability loss, after a long, long time, we are now around the break-even levels and nowhere near the huge losses which we had in the previous 2 years. So that is how the year looks. The numbers look, financial profile, profitability, earnings, outlook looks good. And probably we hope that this should continue as we go along in the near future. In terms of awards achievements, we continue to be nominated. Recently, we were adjudged the 3rd best in the industrial sector category for investor relations. We've been finalists in the Dry Bulk Operator Managers Awards. So this is something which we are nominated all the time. If not being awarded, we are always among the finalists. We are always among the nominees. And we continue to remain up there in the shipping world in terms of our reputation as ship owner as well as a ship operator. These are some of the certificates, some of the credentials which we have got. About a couple of years back, we also were awarded something on the sustainability side. In terms of corporate governance, we continue to remain very, very high in any kind of ranking because we think corporate governance is something which we should not ignore, or it should not be done just for the sake of complying with regulations. So we try and comply or adopt corporate governance in our day-to-day functions, in our day-to-day management, in our day-to-day operations. It's not something which we do purely from a compliance perspective. And that, as you can see once again, has been sort of vindicated. Our work, our actions have been vindicated by the kind of appreciation which we get from authorities, from various magazines, from various other forums. The IOD and National Corporate Governance Committee comes out with a ranking of listed companies. In 2017, once again, for the 8th consecutive year, we've been ranked as a 5-star, that is with excellent corporate governance. And within our own sector, we are also ranked as being among the top quartile. So not only do we have 5-star, but even within those 5-star and within our sectors, we are in the top quartile. We, even on an international forums, we continue to be ranked very, very highly on corporate governance. Marine Money New York comes out based on the financials with a ranking. Considering the woes which we have seen in the dry bulk sector, all dry bulk companies are not being ranked highly by Marine Money because obviously the financials, as compared to the other sectors which were doing better, did not show any kind of strength. So obviously the dry bulk companies have suffered in terms of the ranking. So 2016, based on 2016, it has not been, it was of course the lowest ever in history. So obviously the rankings were perhaps again, once again you can say, would be reflected accordingly and were the lowest. If you look at the ranking of just the dry bulk sector, PSL there within the dry bulk sector comes out pretty good. In fact, if you look at certain parameters like return to shareholders, price to book value perhaps is also a sort of a shareholder return. PSL is ranked very, very highly. It's number 2, number 3. The 2-3 parameters on which PSL is ranked low is on total assets turnover, total return on assets. This is because of the fact that the other dry bulk companies do not have that much of assets. So they are getting their return, they got the returns without the assets. We are of course a very asset heavy company, more so now because we have a very young fleet. So we have gone through our rejuvenation program where we have built up assets of $800 million. So with this $800 million, the return in a year where it has been at near break-even or lower break-even, they do not look good if you compare it with the assets. But once again, the benefit of having this young, bigger fleet will come out and will be accentuated, will be seen in the near future when the rates start improving, and then at that point we get better rates than our peers. So that benefit will start, and then you will see that, or even on this front, the ranking will look better. Some of the comments passed, in spite of the lower rankings, Marine Money continues, goes to show the kind of reputation which the company has internationally in the world of shipping. If you look at shareholder returns, if you had invested in the IPO of the company in the year 1993, and if you had kept the shares, not reinvested the dividends, taken the dividends, your position would have been about 13 times the value of your investment in 1993. Not bad considering the fact that 2017 was still during the down cycle. And therefore the share price is going to take some time to reflect the better market position which we see. If you had invested not in the IPO, but if you had invested at different points in a, say every 5 years cycle, notwithstanding any point at which you had invested, by and large you would have had positive returns if you had seen in the last 25 years, barring the year 2010, where there is a slightly, you would be in a slightly negative position. That is, your 1,000 baht of investment would be worth today 876 baht. But now, as we see share price being more reflective of the actual profitability or actual earnings potential of the company, this negative will also probably be wiped off by the end of this year. So therefore, at any given point of time, if you had invested in the company's shares, if nothing else, even if you had not made handsome returns, which you have done, which you may have made, depending on the timing of investment, but even without that, you would have at least not lost any money. So with that, we close our presentation and throw the floor open for questions.
Sorry, can you repeat your question? Yes.
Continue. Oh, thank you. So, as we see that China still export is decreased.
Correct, it's decreased.
Yeah, a lot. And what is your view in the future, and does it affect the growth of the revenue?
No. Remember one thing, the steel markets is the international market. China was exporting to the rest of the world. When China slows down its exports, it's still exporting, but it's slowing it down. Countries like Japan, South Korea, Taiwan, they are filling the gap and they are exporting. Whatever China is not exporting is being exported by the other countries. So there's no real net reduction in tonnage. So there is more demand coming in from steel anyways.
So another question is about, as we see that you try to repay the debt, so how to fund the CapEx for further
growth? Yeah, so right now in this cycle, we don't plan to have any further capital expansion. We would like to see how the cycle plays out, try to reduce the debt, lock in the ships on longer term contracts, and then when the next cycle comes around, when the market comes down, that's the time when we will look at buying ships. But not in this cycle. This cycle now, the buying is over. We've already got a very young fleet. We don't have to do anything further now.
Thank you very much.
Okay, so whilst we are waiting for questions from the floor, we have got 2 questions from the net. On the first question from the net is, how would the company be compliant with the new sulfur regulations? As I said, in the first year, our plan is to burn clean oil and therefore become compliant. And in the second year onwards, depending on the cost of scrubbers, depending on the differential in price between dirty oil and clean oil, we will then make a decision whether we should continue with clean oil or go in for scrubbers. There is a second question from the net. It's in Thai, but the question means, does fuel cost affect the company? As we've always said, a fuel cost is something that is a pass-through charge, and it is the client's account. Our model is very similar to Hertz Rent a Car, where when you go to rent a car, you take the car, but any petrol that you burn in the car is your account as the client. And that's the same thing with our ships on time charter. We basically give you with the driver the car, but all the petrol is on your account.
May I ask some question, please? I saw your content that show that the Chinese try to focus to produce the higher quality steel, and they aim to cut the production of the normal steel. In your opinion, do they need to import iron ore more or less?
More iron ore, because for special steel, you need good quality iron ore. Plus, the main factor in China today is not only just the quality of steel that they're producing, but the quality of the emissions which take place from the steel mills. The pollution caused is a bigger problem. So if you take low quality iron ore, then you will produce more pollution. You take higher quality iron ore, you produce less pollution, and you produce better quality steel. So it solves both the problems at the same time.
That means although they try to cut the production of the normal steel, they do need to less import the iron ore, right?
Yes, so they're already closing down many of the iron ore mines. As I said in my presentation, 1,000 mining licenses in iron ore have been withdrawn. So they are cutting down because their quality of iron ore is very poor. So they don't want to produce iron ore domestically, they want to import it.
Nothing on the web. Only two questions.
So if there are no further questions, then I must thank you for being such an attentive audience. Thank you so much. Sawasdee krap.